said, my next guest says they all still qualify as GARP, as growth at a reasonable price. Joining me now to explain and defend is Drew Pettit. He's director of U.S. equity strategy at Citi Research. Drew, it does crack a few of us up to be trading at 95. This is not NVIDIA from 2023, okay?
Yeah, this is the problem when we look at some of these growth stocks that are at relatively early stages, right? We get these head fakes on PEs and even EV to EBITDA when we're kind of looking at the near-term numbers that are kind of close to zero. So look, mathematically, yeah, that PE is right. But when you look at this over the medium term and you look at the growth trajectory, these stocks still look reasonably priced based on the DCFs.
On the DCFs, the discounted cash flow. So let's say I said, all right, convince, like I'll take DoorDash. I think that was one of the ones trading at like 9. I use it all the time. I'd love to know, based on discounted cash flows and all that stuff, I mean, give me the legitimate case for this company being cheap or inexpensive right now.
Yeah, before we go into the actual DCF, let's talk about the reverse DCF. What's the market pricing in? So let's assume price is right here. What kind of growth rate do we need in the next 3 years for DoorDash to really make sense? And the market's pricing in 20% annualized growth. That's great. That's a pretty high number. But if you look at our analysts and consensus, they're way above that. So the sell side, the analysts themselves see 35, 40% earnings and free cash flow growth from here for a stock where only 20% is priced in. The key to hitting those numbers is really operating leverage. And as DoorDash has really grown, not just its traditional restaurant business, but other delivery and verticals have come online, and they're all beginning to get profitable. You'll see that in grocery. You'll see that in international as well. That's all key to this stock, really beating that 20% growth number that's priced in.
Yeah, I think it's not crazy. I mean, I remember Netflix 15 years ago. We used to hotly debate whether the 100 times PE was completely insane or justified. And look at the answer. It was incredibly justified.
Yeah, it's all about leverage for these platforms, right? When you're in earlier stages, that's where you really start to see the growth ramp. So every dollar from here gets incrementally more and more profitable, and that E starts to move really, really quickly. You know, PE has to come down for these stocks to really work. But again, it's all about the growth, and it's all about the DCFs to us.
Let me ask you one that I just not as much a fan of. So I question the valuation a little bit more, and that's DraftKings. In the case of a DoorDash, some of these companies, you can see how those early kind of benefits of getting those users in, you get this flywheel approach, it works out in the long run. A name like DraftKings, I just wonder if they're kind of benefiting from, you know, subsidized customer acquisition costs and, you know, how much they can kind of keep engagement and all that over time.
Well, it's kind of the beauty of being a pretty big player in a space that probably only has 2 or 3 scaled players on the digital side, right? So, yeah, customer acquisition costs coming down really helps EBITDA and free cash flow of this company. But we look at where we are today, and this is a company that's already announced a buyback. So it already has some free cash flow optionality. So this is an interesting one because we still have like negative free cash flow and some like backward looking data. Earnings is still negative. You know, market's probably pricing in like $1.25 of free cash flow in 3 years from now. Analysts see that operating leverage here turning on. We're at that pivot point. And what is modeled by the street in Citi, it's in excess of 250. So you're kind of buying a stock that's got $1.25 priced in, where analysts think you're going to get 250. Again, that's GARP to us.
That's interesting.